change. The Momentum Investor Confidence Index combines financial indicators that gauge the level of investor confidence in the markets. These include market breadth and liquidity, investment return expectations, and investor psychology. So joining me in the studio for more details on this index is Brendan Howie, who is the Deputy CIO of Momentum. Hi, Brendan. Now, this is an index. It follows in the wake of two other interesting indexes that Momentum had announced: the Wellness Index, a financial wellness index, and the Household Index. They've done pretty well for you.
Yes, they have. I mean, there's some interesting parallels between those and what we've launched now. Those really look at disposable income and net wealth. So individuals can gauge where they are versus their peer group. Are they saving enough? Have they managed their debt correctly? This index is about investments.
So let's talk about investor confidence, because it's one of those words like value, or two words like value. It all depends what you define as investor confidence.
That's right. I mean, I think if we ask 10 people, we'd get 10 different answers on what confidence means to them. So we've tried to take a comprehensive view of investor confidence, and there's 4 aspects we look at. It's liquidity, so will you get your money back as and when you need it? The ability of the issuer to pay you back. And historically, that meant looking at a company like Standard Bank and saying, can they pay you back? But with what's happened in Europe, you now have to look and say, can a country pay you back? Yeah. So it's become more interesting. Also, the other thing is, will the investments pay the income that they promise, and will the investment not lose you capital?
And you also on your list talked about the issue of investments remaining solvent. I suppose that's part of whether they're able to pay you back.
Yes, yes. So solvency has become an issue for governments and for
and
companies.
Unthinkable just a few years ago. I mean, bonds, for example, default on bonds. This was unthinkable for sovereigns. Now it's really very much an issue. So, okay, those are the principles of investor confidence, but now you've got to put it together in a measurable form. Now, not all of these things can easily be measured. I mean, you talk about a lot of them is about perception, surely.
Yes, valuation is one thing. So we can take a view on the market and say they're cheap or expensive. But in the short to medium term, it's really sentiment and behavioral issues that drive the market. So we've tried to come up with a number of underlying indices which are publicly available. Some of them are quite choppy, so they'll go up and down each month. But we've managed to get some information out of those indices and combine them in a way that makes a lot of sense.
Give me an example of how you go about it and what you would choose to use as a measure.
Okay, there's 6 components. One is one that people will follow quite closely is foreign inflows into the country, in and out. So from month to month, those numbers go up and down and up and down. But there is a trend that you can see if you average some of that data out. And generally we know if money is coming into the country, either into our bond markets or in equity markets, it's very supportive of local markets.
So that's a factual measure. What are some of the others? You've got volatility.
Volatility. So volatility speaks clearly to the price of protection in markets. So it's a key driver of the price of derivatives. So when volatility is very high, the price of protecting your assets is high. So it shows that there's demand for protection and investors are nervous. And on the contrary, when it's very low, it's quite cheap to get protection, and people generally aren't looking for protection at that point.
Now, you've got another one which looks quite complicated, or not complicated to you, but certainly perhaps to people who are trying to... The gap, the spread between the 10-year sovereign bond yield and the repo rate. So give me numbers for that and explain how that works.
Short-term interest rates versus long-term interest rates. Now, that's been a key driver of markets over the last couple of years, and that both our central bank increasingly and offshore, you've seen people keep interest rates close to zero. So what that tends to do is it doesn't pay you to keep your money in the bank, because you're going backwards in terms of inflation. So there's a lot of money that's out there that needs to find a home, and it's supportive of assets if interest rates on the short end are very low.
And then you've got the all-share index trading volumes. What do trading volumes tell about investor confidence?
Trading volumes tell us a few interesting things. If they're too low, they tell you that the market's somewhat dysfunctional, so you need a lot of liquidity, and the JSE is typically a very liquid exchange. But you don't want to see too much volatility. It means that the investors are coming in, staying for a very short time and buying and selling it at short notice. So they're not long-term investors. We want to see holding periods of stocks picking up. That means there's a lot of long-term confidence in holding stocks as opposed to speculative activity.
Now, this is similar to the PMI and to other indexes. It's a very useful and accessible way of doing it. You say 100 is the maximum, 50 is in the middle. Above 50, it gets better, there is confidence, and below 50, there isn't. So where are we at the moment, given all these indicators that you've put together? And obviously what you're doing here is taking more than a daily or weekly view. You do have to do that. Where are we on that scale right now?
It may be surprising when you think of what's happening in China slowing down, Europe in a mess, the US consumer is still under pressure, But there is confidence in the markets. We went from 60 to 64 with our last data release, which we're releasing monthly, which show that's a healthy level. So despite the fact that there's a lot of bad news out there, the conditions are still right for markets to be supported. And you've seen the Aussie responding to that.
Now, you've had some basis of comparison too, because you haven't just invented this last week. You're actually revealing it now, but
Yes.
you've been using it for some time for your own investment purposes.
That's right. Together with our partners, ETM Analytics, we've studied these measures over a number of years, and we've now decided that we've got the right measures in place that we can release quite timelessly, because everything's available sort of the first day of the month.
So you said 60 to 63. What's the worst it's been over the last 10 years?
It's gone down below 30 in 2008, and on the back of dysfunctional markets. So
And I presume accessible through a website if people want to have a look at these indexes that you've created?
we are going to be releasing it much like the PMI or the GDP numbers. Inflation will come out, but it is calculated daily as well and will be available on our website.
It'll be very interesting to watch, and a correction to our short-termism, almost in our nature. We have to talk about these things on a daily basis, but this gives us a longer